International versus domestic tax planning for the crypto investor was one of the key topics at our recent Conscious Crypto event. We brought in the Offshore Citizen himself, Michael Rosmer, to speak on this and other financial structures you need to understand as a crypto investor. Before we dive into the following segment that we've clipped out of his much more intensive presentation, please don't forget to hit the like button, subscribe, click the notification bell, and hit all.
So what I'm going to discuss is to start off with a little bit of the contrast between what most people are used to, which is domestic tax planning, and contrast it with international tax planning. We're going to cover a little bit around kind of, depending on your use case, depending on what situation you're in, the way that you make money, et cetera, the strategies are going to be different for you. Also, depending on where you live in the world, the strategies are going to be different than you. So I'm going to try and give you some mental models, some frameworks for how to think about this stuff. And if you have questions afterwards, you can ask me, or you can always reach out afterwards. I'll leave my email address, et cetera. And I produce lots of videos on this sort of thing, et cetera. So I really encourage you to, like I said, ask questions, be curious, and go from there. So if you think about what most people are used to, they're used to domestic tax planning, right? And what is domestic tax planning about? It's like, okay, I want to maybe get some deductions, right? Have less taxable income, or maybe hold an asset for longer. So if you're in the US, long-term capital gain is taxed at a lower rate than a short-term capital gain. If you're in Germany, then holding for over a year could result in no tax. Again, just depending on where you are in the world, there's going to be different rules. But generally speaking, there's different types of income, and different types of income are taxed differently. Now, unfortunately, if you're actively trading, this is generally regular earned income. And regular earned income is some of the most difficult income to pay attention to. And so we'll talk about it, talk about different ways to do it. But I think that it is worth realizing from the outset that in this world of crypto, we have lots of different types of income. We have, staking income, we've got yield farming, we've got trading income, we've got long-term holds, then you enter NFTs, there's a whole bunch of things that happen there. And so each of these have kind of their own unique tax characteristics. But generally speaking, you can think about the fact that, are you holding it long or short term? That's one difference. And then, is what you're buying increasing in value, or are you getting more of it? So if you're lending, if you're staking, if you're yield farming, generally that you're getting more of it, right? So you have more tokens at the end, as opposed to having those tokens be worth more. And so that's maybe just like a little bit of contrast for you to think about. Now, when we think about international tax, what are we thinking about? We're thinking about, how do we move that income to some place that is a lower tax rate or has better tax rules, right? So, for example, maybe you're in a situation where you're in Australia, and taxes in Australia are terrible. It's a terrible, terrible place to be from that standpoint. And hey, listen, if you can move that income to someplace like, Cook Islands, or to Cayman Islands, or to Costa Rica, maybe you can pay a lower tax rate. And there's going to be a couple different ways we're going to talk about doing this, but the important thing is to note that you're going to move something from one place to another, as opposed to trying to reduce how much you claim to earn or how it's taxed. Okay. So how do you do that? Well, you have to either move yourself, or you have to move the income. This says move the money, but really it should be move the income. If you relocate, a really simple example, you can see on the slide here, you've got California and Texas. California is like, the most draconian part of the US, and they've got these terrible state taxes on top of the federal taxes. So that wasn't bad enough to have US tax in general. You get the state tax, and you can be over 50%, and that's awful. Versus you could go to, Texas or Florida or some of these other places where there's no state tax, et cetera. Now that's if you're looking locally. If you're looking internationally, then it becomes a whole other level of what you can do in terms of relocating yourself. And so then you can follow the path of someone like Teresa or myself, who left Canada and went to a place where we have better tax treatment, among other things that might be a little bit more appealing to us. One thing to be aware of here is that some people may not want to relocate, right? Maybe you have reasons, practically, you have kids in school, you're in a situation where you have family, you have other commitments, etc. Maybe you just don't like this other place. So in those cases, we're going to discuss some of the options that might work for you, depending again on how it is that you earn the income. And that's kind of the more complex state. So we're going to kind of go on from there. Now, really what this question is when we talk about attribution is we're really asking whose rules apply, okay? So whose rules apply to your income? And it turns out these are always determined by three different things, what I call the three pillars of residency. So we're going to talk a little bit about how these apply to you. But the whole point is just to think, okay, how do I know who gets to tax my money? Okay, that's the basic question. So now there's one way you can have it is you can have a company. And one of the things that I think is probably underrated in the world of crypto is that you get a lot of people who have never been in business who are thinking about, they're just making money. They're used to making money. And right off the bat, whether you're domestic or foreign, I find that usually when working with crypto investors, crypto traders, etc., that one of the smartest things to do is to have a business, okay? You're going to get yourself a lot more flexibility by having a business. Now, it's not always necessary. You know, you can move to some places and take advantage of without it. You could go to Bahamas and there's zero tax, and that's great. But if you're in most places, being able to earn your income through a business can allow you to have write-offs. It can allow you to relocate the income more effectively. It can allow you to spend, there's a bunch of different advantages. Not to mention one of the things that's beyond the scope of this conversation, but as you start to make a lot of money, you know, there may be asset protection concerns and, you know, all sorts of other fancy things. So that's a very important thing to consider. So if you start a company, a lot of what people have maybe a little bit of a naive view of offshore, which is one of the most common questions I get from people is they'll say, you know, can I just form a company in Belize? Can I have a Belize IBC, just pay no tax? And unfortunately, the answer is, if it was that easy, everybody would do it. And, you know, the IRS or CRA or ATO or HMRC or whoever else would be out of business. And so they made rules to prevent you from doing that. So in most cases, you cannot just go and form a company abroad and not pay tax. You do often have to do that, but it's not sufficient in itself, okay? And the reason for this is that countries have come up with what we call corporate residency rules, and these are determined often, not always, but often on the principle of what's called management and control, okay? So in other words, if you were to, let's say, sit in Canada and you formed a company in Belize, but you managed and controlled it from Canada, it's the same as having a Canadian company. You literally get zero benefit from a tax standpoint. And so in that sense, it's not sufficient to do that. So what we have to do is, if we're going to use a company, then we have to make sure that company is genuinely foreign tax resident. And that comes from having this, either having the company itself be managed and controlled abroad, or sometimes you're in a situation where you can take advantage of tax treaties, and those tax treaties will override it. So for example, today I'm sitting here, although, you know, I have this nice tropical background on this Zoom thing. Actually, I'm in Bulgaria and it's, you know, raining out and not so pleasant. But one of the things that's nice about Bulgaria, say in relationship to Canada, is there's a tax treaty that works pretty favorably, so you actually can benefit in that regard. So that's something to be aware of, okay? Now, the next thing is we've got, beyond companies, we have income. And one of the things that's really important to note is, generally speaking, no matter where you live, no matter where you have a company, etc., most places will tax what we call domestic income, okay, local source income. This is where it gets a little bit tricky because I was mentioning the different types of income, right? So let's use some examples. Let's say that you're in a situation where you are buying some Bitcoin through an exchange in another country, right? You can ask, where is that income located, right? The Bitcoin goes up and now all of a sudden you sell and you have a huge profit. Where is that income? Is it where the exchange is? Is it, you know, nowhere because it's in the ether and, you know, Bitcoin is very decentralized? Is it located in, you know, where you are? And so, I mean, as a general rule, capital gains tend to accrue where you are. So we're going to talk in a second about your residency. But that being said, it's really useful to be aware that that's the case. Now, other types of income might not be, right? Maybe you can have very often, for example, lending income is based on where the payer is located rather than based on where you are. Now that can work both for and against you. So you can be in a situation where sometimes you want the income to be located somewhere else, and you can also have it be hit doubly. So this is, I think, a great time to introduce a few different concepts here. One is, so what does tax residency mean? Tax residency is this idea of whose tax rules apply to you. And my point in kind of going through these three types of residency is that it can apply to your income, it can apply to you, and it can apply to companies. If you're in a situation where you say, okay, I moved to such and such country, maybe their tax rules apply to you. Now, the crazy thing is that doesn't necessarily preclude some other places' tax rules from also applying to you. Okay, so you can be double tax resident, and equally, you can be tax resident nowhere. So this is, if we think about it from a corporate structuring standpoint, you might have heard stories in the news, et cetera, about how Apple had this famous structure based out of Ireland. And a lot of people think, oh, Ireland, it's this big tax haven. Actually, it's not. What happened is that there's a mismatch between the tax residency rules in the US and in Ireland. And so Apple was able to claim that two of their subsidiaries, Apple Operations International and Apple Sales International, were tax resident nowhere for like decades and pay virtually no tax on those companies, which was pretty great for them, great for their shareholders, et cetera. So that's something to note. So why do I mention this? I mention this because even if you set up a foreign structure, okay, if you are involved in doing certain types of work, you could be triggering local rules. So you may find that there's a need to travel, or there may be a need for you to hire people abroad, or there may be there's lots of different things that you could do, but you should be aware very much of how this plays out. Okay, so think about where the income is earned, not just where a legal person is. And this brings us to the third, which is the residency of individuals. And for many of you, this might be the easiest thing to do, right? If you're willing to go and relocate abroad, by far it's the easiest option, unless you're an American, and we'll talk about Americans in a second. If you're somebody who is going to be willing to relocate out of your country, then you can go and you can live somewhere else. And so we'll talk a little bit about what are some good places to move for the purposes of crypto. Okay, so let's start with some places that are not the worst but not the best. Okay, so France is normally a terrible place for tax. They compete with Denmark every year to have the worst taxes in the world. But interestingly, when it comes to crypto, if you're a trader, you don't pay tax until you convert to fiat. So that's very useful. You can trade in and out of all different tokens. You can do all these things, and until you convert to fiat, no taxes. That's amazing. You can look at, I mentioned before, someplace like Germany. Germany, again, terrible for tax. They're really, really quite awful. But if you're a long-term holder, then if you hold for over 12 months, then it's tax-free. So that can be great for people who are maybe not going to be so actively involved and they want to do this. Someplace like Netherlands. Netherlands has, they consider crypto to be something called box 3 income, and they have this sort of quasi-wealth tax. So you get pros and cons of this. What does this mean to you? What it means is that if you pay tax regardless of whether you make or lose money, but it's a very, very small amount. So because in crypto we can make so much money, our profits can be huge percentages. As a percentage, this can end up really, really low. Portugal is super famous for being a crypto kind of tax haven because they basically regard crypto as currency, and so they don't tax the fluctuations and differences in currency values. It's not tax-free to trade, to yield farm, to stake, to lend, but it is to just, again, buy and hold and then sell. So that's great. And then one of the cool things in someplace like Portugal is they have something called the non-habitual residency regime, which allows us to set up a corporate structure. So I get a lot of clients who come and they're maybe in a situation where they want to relocate to someplace like Portugal, but they're earning income actively from crypto. And in those cases, what would you do? You would set up a foreign company There's lots of rules around this. This gets kind of complex because they have a blacklist. You have to worry about the blacklist and all this kind of stuff. But you could use potentially a foreign company, and the foreign company can earn the income, and then it can pay you a dividend. The dividends can be tax-free. So that's another one. Another interesting thing in Portugal is if you're into NFTs, people can get royalties, etc. Well, royalties income under the non-habitual residency are tax-free. Then you have places where they have a lump sum tax, like Italy and Greece and Switzerland. So this is where there's like just a certain fixed amount, like 100,000 euros a year in the case of Italy. And that's it. So is this low tax? Well, not if you're a low income earner, but if you're earning a lot, then, it might be a huge, on $2 million, that's 5%, right? So it could be quite decent for you. Then there's some low tax places like Bulgaria, places like Georgia can be good. Cyprus doesn't tax the sale of securities. They're great. Big mecca for crypto is Dubai, where I spend a good portion of my year. So Dubai is just zero tax. There's a great digital nomad visa in Costa Rica now, and Costa Rica has some great rules around this. Panama has some pretty good rules. So there's lots of places, and if you're interested in relocating somewhere, certainly reach out to me and we can discuss those options, because there's often a place for most people where they can go if they're interested. If you're not, then you just have to be aware that by you being resident and owning a foreign company, you can trigger this set of rules called controlled foreign companies rules. And I'll skip kind of the details of those for today, but the bottom line is that there's a set of rules you have to plan around. And so sometimes what we do is we put into place other structures like trust structures and trusts and foundations, and you'll start to do things like that. So anyway, that gives a little bit of an idea of some of these things. Okay, so hopefully that's useful.
Thanks so much for liking the video, subscribing to the channel, clicking the notification bell, and selecting all. For the full masterclass taught by Michael Rosmer at the Conscious Crypto event, as well as masterclasses taught by a number of other expert speakers, people like Chris from MMCrypto and how to place a legendary trade, Da Vinci Jeremiah talking about the little old lady trading strategy, or Jeroen van Lange from the blockchain today, teaching some of the most solid foundational principles of Bitcoin trading. For these and other masterclasses, please hit the link below to sign up for our Conscious Crypto event Masterclass Series. We want you to invest in yourself to become one of the top upper 1% of profitable traders. So until next time, trade consciously.